Amplify Protocol, tokenizing audience reach as a decentralized attention market. Introduction. In a world where attention is the most coveted currency, social media platforms have become the gatekeepers of influence. But these platforms are not neutral. They tax, throttle, and algorithmically distort access between creators and their audiences. Advertisers pay platform owners, not the creators themselves. Creators, meanwhile, rely on opaque algorithms and brand deals, not transparent markets. Friend.tech, launched in 2023, was an early attempt to tokenize attention. Its idea was provocative: let people buy shares of other people and gain private access. But what followed was a frenzy of speculation, misaligned incentives, and eventual collapse. Yet embedded in its failure was a critical insight. Audience reach is a real asset. It just hadn't yet found the right protocol wrapper. Amplify Protocol takes this insight further. What if we could create a decentralized, transparent marketplace where audience reach was tokenized and sold not as clout, but as commitment? What if influencers staked their audiences and users competed to rent that reach for a moment, a meme, or a mission? This is not Web 2 marketing with crypto lipstick. This is programmable reach. This is audience as a service. This is the Amplify Protocol. The problem: the centralized attention economy is broken. Opaque pricing. Want to reach 50,000 people? Facebook won't tell you the actual cost per human, only cost per click, and even that's gamified by their algorithms. Rent extraction. Platforms take the lion's share. Influencers rarely earn directly from amplification, only from external brand deals. Misaligned incentives. Advertisers want reach. Creators want revenue. But the current stack inserts platforms as toll booths, not coordination layers. No market for influence. There's no protocol-native marketplace where users can transparently bid for verified reach, nor a way for influencers to commit their audience in advance. Friend.tech tried to solve this, but fundamentally misunderstood the commodity. Access does not equate to value. Without purpose or structure, tokenized identity becomes a speculative dead end. Postmortem. Friend.tech's MVP was deceptively simple. Users could buy shares of someone, usually a crypto influencer. Shareholders gained access to a private group chat. The price of shares moved dynamically as more people bought in. Critical flaws. 1. No scarcity of access. People already share ideas for free. Gating access to low-value influencers didn't make the product more desirable, only more paywalled. 2. Speculative Ponzinomics. Influencers traded each other's shares to pump volume. It became a mirror game of cloud inflation. Value wasn't created, only cycled. 3. No infrastructure. There was no underlying protocol, no utility layer, no long-term coordination mechanism, just a UI wrapper and volatile incentive loop. 4. No real coordination. The core idea, own a piece of someone, turned out to be socially awkward, economically hollow, and ultimately unsustainable. What Friend.tech proved was not that attention can't be tokenized, but that it must be done with a real substrate, a coordination layer, a clear, functional marketplace. The core innovation: Amplify Protocol. Amplify doesn't tokenize people. It tokenizes reach. It treats attention like what it already is, a finite resource with measurable impact, traceable delivery, and scalable economic value. Key components: influencers stake commitment. Influencers join the protocol by committing to share campaign messages from winners of audience races. Failure to follow through results in withdrawal penalties. Users compete for attention slots. Users pledge NFTs or tokens to enter a scheduled raffle, race, or challenge. The winners gain the right to submit a campaign message, which is broadcast by all staked influencers. Token or NFT framework. Users need Amplify NFTs or tokens to participate. These can be won, traded, or bought, creating a secondary market for access. Web 2 plus Web 3 hybrid. While Amplify runs on-chain, it integrates tightly with social media platforms like X, TikTok, or Instagram. Wallets are linked to social accounts, and influencer commitments are verifiable via public posts. DAO moderation layer. A lightweight community governance system reviews campaign content before distribution, ensuring quality, compliance, and reputational safety. The result is a programmable reach layer, an attention market where supply and demand meet transparently. Section 5, Mechanism Design. The Amplify protocol is designed around a simple premise. Attention can be rented, not just bought, and it must be earned. 1. Campaign races. Each campaign slot, daily, weekly, etc., is awarded via a verifiable, transparent raffle or contest. Entry. Users must stake an Amplify NFT or Amplify tokens to enter the contest. Race mechanism. The protocol uses a VRF, verifiable random function, or challenge-based game, e.g., social task, creative prompt, to select winners. Win condition. Winning users earn the right to submit a campaign message for amplification. Post-approval. Campaign content must pass DAO moderation to proceed. Influencer commitments. Influencers are the supply side of the marketplace. Staking mechanism. Influencers lock their commitment into the protocol, e.g., for 7 days. During this period, they must post winning messages on their connected social platforms. Verification. The protocol verifies that the posts were made via on-chain event plus Web2 API checks. Reward flow. Influencers receive NFTs or token payouts for each valid message propagated. This creates a predictable, tradable reach commitment market. 3. Token NFT logic. 2 core design paths. Option A, fungible token model. Amplify token, used for campaign entry fees and influencer rewards, traded on Uniswap or a similar DEX. Protocol fees, e.g. 2%, collected and redirected to a treasury, buyback pool, or DAO. Option B, NFT membership model. 5,000, 10,000 NFTs grant access to the protocol. NFTs are consumed burned to enter high-stakes campaign races. Influencers receive NFTs as payment, which can be held or sold on secondary markets. Both paths support secondary market speculation and long-term membership effects. Market design, demand, and supply. Demand, who wants reach? Web3 teams launching products or tokens, independent creators seeking virality, brands testing new messaging channels, users driven by clout, fun, or creative expression. Supply, who provides reach? Influencers with real audiences across Twitter, TikTok, YouTube, micro creators looking for new monetization models, communities that coordinate amplification, DAOs, meme accounts, etc. By aligning incentives across these groups, Amplify creates a marketplace for attention, transparent, programmable, and competitive. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 7. Risks, Governance, and Moderation. No protocol can sustainably trade in social capital without confronting the core risks of trust, abuse, and reputation. 1. Content risk and veto power. Not all messages are created equal. Some could be spammy or misleading, politically charged or offensive, reputationally risky for influencers. Solution: a lightweight moderation DAO with veto power over winning campaigns. Influencers retain individual opt-out rights, but repeated refusals may reduce earnings. Optionally, campaign creators can prepay a bond to disincentivize low-effort or malicious content. 2. Sybil resistance and sock puppets. Fake users or bots could try to game races. Solution: require wallet linking to verified social accounts, Twitter, etc. Implement reputation scores or history-based eligibility for high-value races. Use on-chain identity primitives, e.g. ENS, Proof of Humanity, WorldCoin, for access control. 3. Influencer default risk. An influencer might fail to post after committing. Solution: commitment staking. Failure to follow through slashes their stake. Off-chain API verification that cross-checks actual posts. Reputation dashboards to surface reliability and historical follow-through. 4. Governance. Amplify must remain decentralized, but not chaotic. Use a dual DAO model. Protocol DAO manages core upgrades, treasury allocations, economic policy. Moderation DAO oversees campaign content approvals and dispute resolution. Voting power could stem from token weight, NFT tier, or a hybrid. This preserves order without crushing the organic, meme-driven nature of attention markets. Section 8. Design alternatives and extensions. While Amplify's core loop is simple, tokenizing reach via raffled attention slots, several extensions and alternate models could enhance utility, resilience, and long-term evolution. 1. From raffle to ranking. Auction model. Instead of a random race or lottery, users could bid for amplification slots via blind auctions. Highest bidder wins access to a tiered reach bracket. Dutch auctions. Price falls until filled. Dynamic staking. Participants lock tokens or NFTs, and the protocol ranks based on stake weight plus reputation. This increases predictability and might appeal to professional campaigns, Web3 projects, DAOs, activists. 2. Message as primitive, on-chain social actions. What if a message didn't just live on Twitter, but triggered on-chain effects? A campaign could mint a commemorative NFT for all participants. Trigger a vault deposit to fund public goods tied to the message theme. Enable auto splits of revenue to creator plus influencers via smart contracts. This transforms Amplify from attention as a service to a programmable public relations layer for DAOs and creators. 3. Cross-platform extensions. Though Twitter X is the natural first sandbox, the architecture can be extended to Instagram and TikTok short-form visual message campaigns, YouTube Shorts, creator-sponsored video shares, Discord, direct server amplification or airdrop announcements. By standardizing wallet linking and proof-of-post APIs, Amplify can turn into a cross-platform attention exchange. 4. Predictive markets and derivatives. The nature of the race or auction plus measurable outcomes, impressions, engagement, could support betting markets on who will win the next race, futures on influencer engagement, tokenized derivatives on attention metrics. This opens up a financialization layer for digital clout, where audiences can trade on perceived virality. Section 9, Conclusion, Rewiring the Attention Economy. Friend.tech tried to monetize attention, but it confused access with value. Access alone isn't scarce, audience reach is. That's the critical insight behind Amplify. By reframing reach as a programmable, tokenized commodity, Amplify lays the groundwork for a new attention market, decentralized, gamified, and protocol native, where users compete to earn attention not by bidding for ad slots from a platform monopoly, but by participating in public contests, creative challenges, or community quests, curated and coordinated by smart contracts. It's a system with clear roles. Influencers stake their social capital and earn yield. Users earn their spotlight through merit, stake, or creativity. Audiences are no longer passive. They can track, verify, and even bet on attention outcomes. And unlike the opaque Web2 ad economy, Amplify operates in the open. Verifiable, auditable, remixable. Built on Ethereum or a fast L2, plugged into Uniswap for liquidity, and governed by a lightweight social DAO for message integrity. It doesn't just tokenize clout, it coordinates it. In the age of programmable money and programmable media, Amplify is a protocol for programmable visibility. A new economic layer, not just for memes and marketing, but for movements, messages, and memetics. This isn't just the future of influencer marketing. It's the start of a composable attention economy.